Welcome to the Finance Podcast. The topic of this episode, the role of fixed income in asset allocation, with Gilles Dauphine, Andrew Jackson, Ajim Ksaja, Sebastian Zola, moderated by Thomas Breitenmoser.
So it's 1 o'clock sharply. I think it's in English. Yes, it's English. Good. Good afternoon, everyone. My name is Thomas Breitenmoser. I'm head of investment consulting and controlling of Complementa, a local consultant predominantly looking after or advising the assets of pension funds in Switzerland. And today we have, I think, a very interesting topic, the role of fixed income in asset allocation. We just all remember it was just about 2 years ago when we had to pay to give the money to our government, which clearly, if you just think about it, it was at that time a very special situation. It still is when we look back. But now we definitely have some yields back. If the real return is back, is a different story. But we will talk about it, what's the role also itself in fixed income, but also in asset allocation. Now with me, I have a great panel. I have Sebastian Zola next to me. I have Gilles Dauphine, I have Andrew Jackson, and I have Ajim Ksaja. And they will all introduce themselves quickly, what they do and where they come from, meaning company-wise. Please, Sebastian.
Good afternoon. Thank you very much for having me today. It's almost full. I think 2 years ago it would have been empty, so it's a privilege for having us here, for participating in this panel. Myself, I'm representing the asset management of ZKB, where I'm in charge of the fixed income department, and it's a pleasure to have this interesting discussion, and it's a privilege to be here.
So good morning, everybody. Again, thanks for welcoming me. Gilles Dauphine, Deputy CIO of Fixed Income at Amundi, in charge of the insurance business and the credit business within the whole fixed income.
My name is Andrew Jackson, but please don't call me Andrew. My name is Jacko. Only my mum still calls me Andrew at this stage, so I'll get very nervous if you ask me. My mum is quite fierce, that's why. I'm head of fixed income at Vontobel, and I've been heading fixed income teams for just over 2 decades, doing pretty much everything within fixed income over those couple of decades.
I am Mr. X. As you see, the finance has not provided me with the name, so the others. If you read some research paper, it's always Mr. X is coming. We post some questions.
You have an own platform, so it's okay, yeah?
I am heading the fixed income team at Banque Cantonale Vadoise in Lausanne. Pleasure to be with you today and to share with my colleagues some ideas, some opinions.
Thank you so much. I would like to start with what has changed in asset allocation as fixed income being one of the most important building blocks now the last 2 years. What has changed? Maybe also on a Swiss perspective, if you can start with that, Sebastian.
Yeah, sure. Thanks for the question. So I think when assessing what has changed, it's always important to remind ourselves what are the 3 building blocks of fixed income. So we have the purpose of liquidity management. I think this has completely changed. So for a decade, we had the situation where just the current account was the most profitable liquidity investment for Swiss franc investors. And this has completely changed now with the rise in interest rates. So this is clearly visible also in changes in asset allocation, that the liquidity part is now an active management part or a management part for every investor to search for solutions that provide yields that are congruent with the market remuneration. This has completely changed. The second pillar is the pillar of stability. I would say 4 to 7 years duration solutions. There, I think not so much, honestly, has changed so far. It is still a pillar of stability, of a part to balance portfolios, especially now, I would say after the disappointing returns of 2022. It's still, I think, a building block that should provide stability. And then the third pillar is really the yield enhancement pillar, so high yield, subordinated debt, emerging market debt, really credit products, spread products. And there I think it's still something that provides decent value, it's very attractive and is somewhere in between fixed income and the equity part. But the main change in my view is the liquidity section that has completely changed.
Ajim, maybe also I have a little bit on the Swiss franc thinking role. What's your opinion on this?
Yeah, I will go a bit larger to understand, because a big picture, something has changed. the correlation between bonds and stocks are becoming positive. We have not had this since 20 years. Now, they sold 2 years before. You remember this episode that was stocks -10, fixed income -12, some this type of numbers. When they come positive, they come both positive. This is changing. The correlation is becoming positive. What are implications for us on this type of things? Because this major change, it looks like that will stay. If we see all the drivers that are there, this type of correlation will remain positive. What are the implications? We'll get higher returns. If both will be positive, stocks and bonds will be much higher, this 60-40 type of portfolios. Will be more volatility, because volatility is increasing. What it means for us in fixed income, because in fixed income we have government bonds, we have investment grade bonds, let's put there to get this credit risk premium. This is becoming pretty interesting, especially building those portfolios with stocks and bonds. Bonds, what I meant here by investment grade and being around between high yield and treasury, this is becoming very interesting and will provide more opportunities, higher returns, with a bit more volatility. Let's accept this, to preserve this. This has changed, is a major change, at least in our opinion, will stay there. So this is stuff, let's prepare for this. Don't be afraid, because we got afraid on 2 years before, then from this 60-40 is not functioning, here, there, what is the role of bonds? No, it's more role for bonds. It's more role for bonds because bonds are increasing in yields. So those are major, major changes for asset allocation, which goes deep in asset allocation in fixed income.
Thank you. Jacko, you want to...
You asked me to disagree, so
Yes,
I'm just
it's
following,
always good when
following
two
your
professionals
instruction.
have a different opinion about the future.
I'm a very straightforward person. I think it may be the fact that I'm English that makes me very straightforward, but I don't think fixed income has been stable at all. 2022 was the worst year ever for fixed income. 3 reasons. Returns. Returns were the worst that they've been for 100 years in USIG. 100 years of returns, this is the worst ever year in 2022. Number 2, downside participation. The S&P versus USIG was about 85%. So you didn't get any kind of compensation for going in this less risky asset class. It didn't do what it was supposed to do. And the third reason why I don't think it provided stability is that everyone had exactly the same trade on. Every single passive manager, every single active manager delivered exactly the same performance in 2022. So I think active did a shocking job in 2022 versus passive. I'm one of the active managers. You look at active managers, how many of them delivered a 10% outperformance in a down 20 year? None. One. There's one in the audience who's put up their hand. Second thing on correlation, I agree. Backward-looking correlation has been very, very positive, and the downside participation in 2022 was very disturbing for me as a fixed income asset manager, although as a long-short manager by history, I quite enjoyed it, to be honest. I thought it was quite fun to look at some people losing a lot of money because they didn't think interest rates would go up from 0. Literally, they didn't think that interest rates going up was their biggest risk. For me, though, looking forward, and I think that's what we need to be talking about now, looking forward, I can't imagine a scenario where the S&P is down 40% and fixed income participates in that. Because the S&P down 40% is about the US economy getting trashed. And if the US economy is trashed, I'm telling you, I'm pretty damn confident interest rates are heading downwards eventually. They may not immediately. And the immediate reaction to risk assets will be the same. Credit spreads will go up and equity markets will go down at the same time. But eventually, a destruction of the US economy, let's just try to imagine that were to occur, because that's what it would take for S&P down 40, that means rates come down. So I think we're heading back into that really nice territory where I can actually stand in front of you and be bullish about fixed income. I wouldn't have been in that situation 2.5 years ago. I was not bullish about fixed income 2.5 years ago. In fact, I was advocating private markets within fixed income because I thought that was the only place that you could go and actually generate decent returns. I'm in the opposite camp today. I'm bullish about USIG. Sorry.
Okay.
Just a short one for Jacob, because he's coming from Anglo-Saxon world, and this word free lunch is coming from them. So the interest rate 0 to go to 5, nobody was expecting that will be stable. So this is set down. Those type of scary minus 40%, this, the others, check a little bit back in the 100 years or 50 years to be more sure. What percentage of the time has happened? The second. The third for Jaco is that when this thing is taking place, does not mean that it's instantaneously. In every moment when you buy stocks, you sell bonds. We are speaking for strategic asset allocation here, just to put it in the right perspective. What percentage of the time those have been both together or both in the other side? So this is a little bit just to clarify a little bit, because this was the biggest misunderstanding in 2022, that people understood that always the mechanism works. Yes, there are some times that mechanism works, but most of the times, especially on this previous period when this correlation was positive for both classes. So we just need to put a nuance on this type of things. It's not minus 40 sells well.
I'll bring you in, but I want to give Gilles now his opening remarks before we are in this deep conversation. But it's starting well. I like the panel already.
It's good to be there. They're doing the job. So, but I mean, no, I agree with my colleagues on the right. I even would be slightly more provocative. I mean, I think central banks have been doing the excellent job of being where they want to be. Mm-hmm. I mean, real rates are back to 2008 level, more or less, not biting too much. This is what we need to do to digest the enormous amount of debt that we've been generating, notably on the Govy side during COVID. And it is the levels we need to stay at, or at least not increase too much, to, I would say, not completely destabilize, I would say, the stock market and credit, I would say, overall. So the question is, are we going to be able to stay there? Does it mean we have a cap, a ceiling, if you will, on interest rates, at least on the long-term basis, on long-term rates? I think so, at least on the euro. The US, we'll see how it goes. We need to see the data more seriously. But I mean, something has changed there first. And the consequence of this, is that all of us being fixed income guys, somewhat we are living into much better situations. I.e., in the last 4 years, most of the clients we had were institutional clients, being insurance company, pension fund, driven by regulation to buy fixed income. So yes, they were not happy to buy it, but guess what? They had to. I remember buying 30 or 80 at about 50 BPs because we had a big duration gap on one of our insurance companies. We've been able to get out of this trade losing some money, but not all the way down. But I mean, this is what was happening. Today, retail and wholesale is back. I mean, most of the money we distributed last year was either in money market, where people are trying to benefit from the shape of the curve, or I would say target maturity products, where I would say people are trying to find alternatives to deposits, because banks do pay on the deposit side of things, but not on all European markets, if you will. So for me, the next big question is this money, which has been somewhat parked for money market, and I would say which has found some alternatives to deposit on the wholesale, is it going to get back to more sticky kind of benchmark type of products? At least from what I have seen in the first 3 months of the year, it's coming, but it's probably something to watch out.
Thank you. Sebastian, you wanted to add something?
Yeah, maybe 2 things. Gilles mentioned a point, the real rates. I think this is the main thing that changed. So when can fixed income actually provide the stability it's supposed to provide? Is it when real rates are at negative 1%, like we had 10 years before? Or is it in a situation where we have almost in all currency regions 1 to 2% positive real rates, either at the naive side or also market implied? So I think the ingredients are there, that fixed income can provide stability. But what, in my view, is even more drastic changes to asset allocation. We have had 100% in Swiss franc terms positive return from credit. Rates did not provide anything anymore. And stability, I think you mentioned a significant drawdown in the S&P. Stability in the end comes from the rates part and not from the credit part. So can the rates part provide the stability? And I think this has completely changed. So we had the situation 100% return from credit. Now we have 60, 70%, even on a hedged basis, coming from the high quality part, from the rates part, within the fixed income yield space. And I think this has completely changed, and I think it's also a structural change that is here to stay. And this is the second ingredient, in my view, that the stability is back within the fixed income segment. Maybe a bit in disagreement with you in terms of correlation, because I think the correlation on the IG side will change again. If you have a significant drawdown, credit will widen. Credit will not provide the protection that it's actually implied in the yield.
I have in mind a 20-year period. I'm not have in mind what we will do next year. So this has changed, and those are drastic changes. US has had only 2 periods that this has taken place. Has been a period until 85 and the others that was positive, and 85 until recently we have had negative correlation, and only now we are switching. This is what I meant by correlation. It's not the correlation for next year, what we're bringing. And this is just that everybody is prepared when we see the stock goes up and bonds goes up, which type of bonds, investment grade or treasury, let's see it. But this will type of episode that will take place in forthcoming period. And this has large implication because we'll produce more volatility, more returns too, okay, if you change the allocation.
So we were talking about real rates, not nominal rates. I mean, these real rates being returned is just very recently when inflation was down below the real rates. I think just about 3-4 months ago, it was even negative interest rates in many areas. Now, if I think further, we have seen that especially governments have been such a high debt burden when the US is record level, and there's nothing to stop them at the moment. At least it doesn't look like to stop them. We have seen all the challenges which we have. We have to invest in defense and infrastructure, etc. So it's all clear signs that the debt burden will be higher. At the same time, like Italy or so, they have been able to reduce their debt burden just by pure inflation. So if I see that, then why do I want to have, as a government, a real rate for my people when I have such a huge debt burden? And the best way is to reinflate it in there. And I think that's definitely happening. In Italy, you really can see that. So what has that for implication? Or may you say it differently, we have an inverse interest curve, which also tells us that the market is not in an ordinary shape. There is still not everything going on, so there are maybe volatility whatsoever. Maybe you can elaborate a little bit on that puzzle which we see at the moment in the market.
It's good for our money market business, but it's an issue. It's an issue, and I wish we don't stay too long into that space. I think in euro I think the ECB is going to move down this year, at least 3 times for 75 BPs overall at least, which would help reallocate part of this capital, I think. But it's true that there is something which is troubling, which is the US, which is probably spending like they were in a war regime where unemployment is super low, and we don't really know even if Trump is elected, we don't even know what is going to be he can go even more extreme on that front. The only important point also to measure and to have in mind versus history is that if you look at credit, I'm astonished to see the time it is taking for deterioration to come. I mean, our CIO, and I was of course in line with that, our global CIO has been advocating for decompression on high yield for about 2 years. And to be honest, it's only a triple C story. If you look at default rate, 1 year default rate on triple C has been moving from 3% to 9% in the US over 18 months. But nothing is really happening in the other part of the structure. So I think we don't yet fully grasp all the effect of the COVID helps, I think, in the impact of credit market for sure. Which is a plus, meaning that somewhat even if we stay high for long on the short-term rates, probably it will take more time than usual to creep into credit, I think.
I think there's a technical factor that sits behind that, which might astonish some of the less active participants in the audience who don't look at fixed income every day. One of the reasons why creditworthiness has continued to improve in corporates is because corporates have been able to come back to the market in astonishing size, despite what happened in 2022. The appetite for fixed income has meant that the four of us have had to invest very heavily in fixed income. The best example for you of that is my previous employer was Credit Suisse. Very shortly after Credit Suisse went under, UBS issued an A Tier 1. The A Tier 1 on Credit Suisse, I don't know if any of you know that. I know that because part of my remuneration was in that same A Tier 1. It got written off, right? Just less than 1 year later, UBS issued an A Tier 1 that was 12 times oversubscribed before they even started cutting in terms of what they would pay. So the demand for fixed income has been very, very healthy, which means that some of those fixed income names, the high yield names that we all thought, okay, this is great, we're going to start to see some defaults, we're going to start to see some of these ugly, over-levered, predominantly US high yield companies start to go into bankruptcy. They didn't, because they were able to refinance because the market just couldn't get enough of them, which is part of the reason why credit spreads are now well inside historical averages, which is why it's hard for us to stand in front of you and say, you're going to make a ton of returns from credit spreads. So, one of the things you should take away is don't expect a lot of return from credit spreads. But you're right, we haven't seen that decompression. It would have been nice to see some. We haven't even seen it in terms of consumer behavior. We haven't seen mortgage rates be punitive enough that we've seen UK, Swiss, French, German, Italian homeowners starting to default on their mortgages, despite the fact that cost of living has been, pretty high, way beyond historical averages. But we haven't seen mortgage defaults go up at all, nor credit cards. Yeah, even in the US, where people default on their credit cards as a sort of hobby or a pastime, those rates have not gone up. So, as much as I'd love to be more bearish in front of you today, I can't. The credit performance has been pretty good.
Awesome. Maybe you can, I don't know what you want to say. You can answer.
No, I'm
maybe
not
you can go back on the inverse yield curve and to the external debt or the government debt.
We drifted a little bit in corporate.
Yes, we drifted.
But the elephant in the room, at least, is in the treasury.
Yes, government debt.
What is going on? This was what your question was, Thomas. And
yes.
Actually, the situation, let's resume it, because IMF is speaking for this, is a very serious situation. It's not dire, let's put it in this way, because we are not exactly where we are. What are the factors that are? Which are the countries that we are speaking? US, as was mentioned by Gilles here. US is not having control in this debt to GDP. Right now, they are profiting from this fact that interest rates has been low, because you need just to know one thing, a trick of fixed income, that until they renew all the debt to put with high interest rate will take some time. Depends what is the duration of the debt they have. Until now, they have filled nearly half of the pain, let's put it this way. If we'll continue like that, if rates will not change, they will feel the other half of the pain. Not yet there. They have a lot of levers. Let's put it. Those levers are not at all discussed, because have you seen that everybody is discussing for increased taxes in US? Not yet. But if they will begin, because they have a good starting point, we are far from this. But if the situation might come in 4 or 5 years in CBO projection and the others, then okay, they have some levers. Until now, we are not speaking for this level. But the situation, especially in US, is in this type of things, that still the growth is much higher than the cost that you are paying on this. They have a problem with fiscal deficit. This is what we look, or primary deficit. What is the problem that we have in Europe? We have Club Med, the usual stuff, Italy, Spain. And I'm afraid that France is joining a little bit this club, not on this high alert.
It's originally French, isn't it? Oh, go ahead.
No, it's because the French statistics, on debt to GDP, as we say it, it's not the dire situation. It's not the moment that bonds, as one colleague of ours say, are hot potatoes, are sell like potatoes, so you buy, you don't buy. Bonds still have some value. The situation in sovereigns is not that we'll begin to revolt around this, but it's a very serious situation. And in Europe, usual suspect, Italy, Spain is still okay, is in this dynamic. But France is having a little bit a problem in a couple of years. It's not right now. Let's beat. This is the worry that we have in sovereign right now on those type of dynamics.
You're too polite to mention it. because I'm on the panel, but we have had an excellent example of a government overstretching itself and the market reacting pretty adversely to it. Our Prime Minister, 7 weeks I think she was Prime Minister for, Liz Truss, who's published a book about how fantastic she is recently. It's an excellent read, I recommend it. Nearly brought the UK economy down because of exactly the concerns you're referring to, because she said, I'm going to cut taxes and increase spending. And it just wasn't credible. Whereas for the US, we all know they're the checkbook of the world, so they can get away with doing this for a lot longer than the UK, particularly now the UK has left the European Union. And I think that's a bit the difference between the UK and Italy or France or elsewhere, that the European Union has had a show of force and been very, very coordinated in the way it's reacted to things. So I'd look, if you're looking for a sort of really downside case, I'd look at the UK, or I'd look at other economies like the UK, which are quite domestically focused, that might get irrational and might get very, very populist. And there are a few of those around the world.
And Sebastian, please.
If I can add something. I think with regards to government bond investing, that is still 60-65% of the fixed income market. I think the key question is always, how does a government default? And the government defaults on its external debt. I think this is very important to consider when investing in government bonds, and fixed income is in the end the majority government bonds. So the US, Switzerland and the UK, they don't have external debt. They will be able to repay. There will be no failure of pay. The question is just, what is the value of the US dollars, of the sterlings, or the Swiss francs that you get back in the end if there is a serious deterioration of the debt sustainability? So the default in countries that have no external debt comes via a devaluation of the currency. And so this, I think, is a bit the virus we have in Europe. After the euro crisis, we were confronted with a situation where we actually thought that European countries have no external debt, but actually they had, because European countries cannot print money themselves. It's the European Central Bank. So what does it mean for Swiss franc investors? Because I think in the end, the majority here is thinking in Swiss franc. So we have the situation now, you mentioned the rates differential, inverted yield curve, very, very costly to hedge foreign currency because the rates difference is very, very high. So the carry trade has been something Swiss investors are always thinking about, investing in another currency that yields higher and taking the FX risk. And I think if we talk about debt sustainability from a Swiss investor, Switzerland is basically the only, I would say, country with a relevant currency that has prudent fiscal policies at the moment. So the chances that you have issues with regard to debt sustainability in other countries is higher than in Switzerland. So in my view, hedging the currency exposure and really focusing on the hedged Swiss franc yield is prudent, because it will not be a slow, predictable deterioration. It comes like 2011. If there is a question of debt sustainability, currencies tend to depreciate very, very fast and very linear. So I think this is, in my view, the main point with regards to government investing. How does a currency default?
Maybe this is the worry of Chinese that are buying gold.
Yeah, potentially.
Maybe.
Yeah, but I think what you mentioned, of course, is the Swiss franc view. It's very important which currency you look at it. So that's definitely the Swiss franc. And if I understand you correctly, what's trade, which we see also a lot, is now to reduce international government bonds and to buy more Swiss bonds, because you just don't hedge it anymore. It's too much in there. So we see a little bit of a shift there. But Gilles, you wanted to mention something. You all get your airtime, please. Gilles.
No. It's regarding for the Swiss, because it's a sort of particularity. Swiss government bonds. You know how many issues are in the market? 23. You know how much value is in the market? 80 billion. It's very small. And you know what is the structure of the market? All is in long term. Compared to global government bonds, apart from this debt sustainability, which is an issue. So this is this type of, okay, we are not expecting scenarios to be, but you just need to be aware what is the structure of this market. The other market has different type of structure. It's more on the belly, while the Swiss is pretty on the end. Until now has worked pretty well. Everybody here has discussed, okay, this risk adjusted, but just be aware for those type of details if you want to engage in this type of investment on this part.
Time is moving up. I would like to change topic. You already talked about credit, and credit has different segments. Maybe, Gilles, if you start about it, you said we are already back in historical average. Does that apply to all credit market, to the corporate investment grade, to high yield, to EM that? So a little bit if you can elaborate on the credit side, or even the private credit, whatever you look at.
I think to make it short, everything is super expensive on a spread historical basis, but for your IG. If you look at the hit on a historical basis, spread-wise. After, the issue we need to have in mind is that a lot of people are now reasoning on the all-in yield basis, which means that, short-term high yield, yes, spreads are not super attractive, but then, because of the shape of the curve of the front end, plus whatever you get, we see a lot of flows there and interest from people there, because it's taking a lot of time to, I would say, to deteriorate. I would say, and then after you have some specific technical effect you need to have in mind, because we all have been talking about the increase of the term premium on the US curve, but guess what? For now, it's not going to happen tomorrow. You've got the DB pension fund all over the place, who for once see funding ratio back to 100, at least the private ones, the public ones they've got still some way to go. I mean, it means that every widening of spreads and/or rates, they come and buy. It's the same, by the way, on the euro market long term with Dutch pension fund. So this is why, for example, the 30-year part of the long-term part of the US curve is super tight because of this specific effect. So
liability matching stuff there. So.
Yeah. Mm-hmm. So in a nutshell, this is where we are. So yes, it's expensive, but there are flows, and all-in yield means that there are a lot of clients still being interested, to be honest.
Jaco, you want to add on?
Yeah, I mean, I'm on more familiar ground here, talking more bearishly about markets. I do think we are in expensive territory, but maybe not as expensive as other asset classes. Maybe that's the way you need to think about it. Other than private credit, which is at all-time tights, and it doesn't have a very long history, and by the way, it's a floating rate product as well, so it doesn't feel like a great proposition to me right now. But if you look at the S&P, if you look at the FTSE 100, if you look at real estate's had 12 positive years in a row. If you just take US real estate, 12 positive years in a row with a cumulative return of 160% over the last 12 years. European real estate is more than that, it's 180% over the last 12 years. Fixed income looks actually cheap when you look at it versus other asset classes, but versus its own history, credit doesn't look fantastic value. But the more important point, and I think this is the point that you made earlier, is that actually if you look at the riskier stuff within credit, it's done better, maybe the same, depending how you look at it, but better on average than the less risky stuff. So we aren't selling you sexy. That's why they chose the five of us to talk about it. If you want sexy, go and look at China. Go and look at emerging market equities. We aren't selling you sexy. We're selling you downside protection. And actually, if you look at downside protection from a credit perspective, IG looks better value than high yield because high yield has been crushed. And even emerging markets, which is an area that I should be advocating because we're very good at it, but even that has done in line with everything else. So as much as I feel nervous about the future, markets clearly don't, almost everywhere. So I'd go for the least risky, most boring stuff that you could possibly manage within fixed income, and I'm selling that on downside protection rather than generating huge returns.
Okay, I would like to, unless there's something super important for you, I would like to get the audience involved. Are there any questions here, please, to the audience? To the panel from the audience, sorry. I mean, don't forget, US 5% yield, equity 5.5%. That's what you return on.
There's one just there.
It's interesting. Please.
Considering that it's almost certain that the Swiss National Bank will further reduce its interest rate, how can a retail investor exploit this almost certain development?
Maybe the Swiss first.
Well, in the end, as you correctly stated, it's implied in the interest rate curve that there might be further cuts. So I'm not so sure whether it's really a done deal, to be honest, but it's implied. So actually, on the natural rate, without taking any credit risk, it's not exploitable at this moment, because if you invest for 1 year, it's already implied in the interest rate curve that they are going to cut. It's already priced in. So I think at the current market pricing, roughly 40-45 basis points of additional reduction of the SARON, so the reference rate is priced in. So I think it's rather if you expect more, then it's the question, or if you expect less. But if you expect two to come, then it's difficult to profit from this particular event at the moment. I don't know whether there are...
I think you agree.
Yes, exactly. And this is the message, how you want to play it as an investor. CLB, TCB, because it's in the same stuff. ECB is saying every time that they will come, and the 10-year Bund, okay, is staying stick. So the Swissy has done it. So we have the playbook. Maybe we will not repeat it one by one, but this was exactly so. And the type of news it's coming, and what Sebastian is saying, is important, the path. That you are cut 1 time, 2 times, okay, very good. The market can handle this. But usually we are learned to do monetary policy. You begin a hiking cycle, then the other cycle, okay, on this type of stuff. This type of stop and go market does not like. And maybe, okay, is a little bit some element there that they are putting on this. But just watch out a little bit on the Bund and the others, and as this thing will intensify until June. So,
Please.
I'm just thinking out loud, if you were to take like a corporate stock, and if you were to take the same corporate bond, so if you're looking at investing in the stock for price appreciation or capital gains, and you're looking at dividend incomes, if you've done a study on this with, now you're saying correlation is 1, because they're both, like, at least the stock market can go up, but we don't know how much. So I'm trying to understand when you see this coming to some sort of, because you can't keep getting the price appreciation.
Yes, was mentioned a little bit by Thomas, this actually, that how is getting this type of classical Fed model that we name and the others by putting these corporate bonds is not very attractive, actually. This dividend yield compared to this earning yields, let's put it in this way, compared to the bonds today. This is why it's still a room for bonds. This is why bond progress, because usually we are learned to have a little bit of gap between earning yields in stock and yields in bonds. So this type of thing is getting pretty tight. Imagine your example that you are adding a corporate bonds, which is much higher than govies. This is a little bit the story. So this is why it's still room in asset allocation for bonds.
It's liquidity, right? With the stock you can leave, but with the bond you're hopefully investing it for long-term dividend income. I don't know.
So we have stopped this type of thing in bonds, because bonds, if you would have come here in 2022, not 2023, we always have been playing for price appreciation. Now we are coupon clippers, at least if my colleagues will agree, but okay. And we are pretty happy with this.
We have a lot of noting here, it's okay.
So it's not that we are playing for price appreciation on this type of things.
No,
it's more coupon.
On the stock, you're playing for the price appreciation.
Exactly.
I'm talking about asset allocation. That's why. Because, I mean, as an asset allocator, you can go to the stock or the bond, right?
Yeah, I think he mentioned already before here, it's much more downside protection. You have a decent return. It's not appreciation you look at. It's much more, I have that more or less for certain, where the other one is speculation. Of course, both has its room, but now the attractiveness to each other has closed down much more. That's what I want to mention. And refinancing costs for the company, which of course leverage, etc., which goes into earning, is also more costly. Therefore, if you think that through, the earnings ability is not as high, which makes, again, the bonds more attractive to equities than it used to be like 1 or 2 years ago. That's all we say. We don't say that you will get, or I agree.
Yeah,
I'm not the asset manager,
exactly,
but at least we don't say that appreciation comes up there, so it's much more stable return.
But this is exact message to get from this. Why is the role of bonds on this type of new picture, apart from this, that we'll have periods that both might sell massively, or one goes up, one goes down, but in a longer frame.
May I get another questions over there? Thank you so much.
Yeah, let me ask you a quick question, very simple and naive question, sorry for that, but I am working in the private banking sector, and to be frank, all my clients are in Middle East, and they ask me a very, very simple question. Where is the pickup to select a fixed income instead of select a cash enhancement product? During the last couple of months and quarters, we saw a lot of structured product guys came to us, the investment advisor, the private banker, to sell this kind of 100% capital protected product, yielding something like 5.5% in USD based. And when I discuss with my clients, the fixed income, IG US, it's maybe 6, maximum 6.5. So
you're talking US dollars, huh?
USD, sorry for that, only in USD based. So it's a simple question, but how we can convince our clients to stay invested in the fixed income side?
It's simple. I've been doing this kind of product for a while before. I mean, in the second one, you buy a zero coupon bond and you buy a call on the stock market. Okay, volatility are relatively cheap those days, so it comes cheap. But then your call can expire worthless, and then you've been putting 100, you get 100 at maturity. Thanks for coming.
Can you tell me, by the way, can you tell me how you get 100% capital protected?
You buy a zero on D1 and with
But,
credit.
I mean, from Credit Suisse, for example?
Yeah.
No.
From Credit Suisse, from UBS, from Lehman, from, because there is no such thing as 100% capital protected. If we're having a conversation about the US government potentially defaulting, then we shouldn't really be talking about 100% capital protected. So 100% capital protected, embedded within that is a fixed income product. Undoubtedly, there's a fixed income product below the surface. The fact that it isn't being sold that way, the fact that it's being sold as a cash solution does not mean it's not fixed income. So I'd be mindful of the fact that fixed income can compete once you expose the fact that that is also not 100% accurate, the 100% capital protected.
I'm talking about the major banks. The major banks are issuing this kind of product,
like Credit Suisse and
like a major bank as well.
JP Morgan, let's say.
JP Morgan's okay now.
No, but I mean,
I know it sounds very flippant, but I've worked in fixed income for 25 years, and I've seen banks that I thought were perfect default. I saw 3 Icelandic banks default in a year, all of whom were AAA rated. So I don't want to leave you all feeling like I'm Mr. Grumpy Pants, but I think 100% capital protected we shouldn't be saying that anymore.
Okay, any further questions? Sorry about that. So I think you got a real message. Buy fixed income, guys. So
but by the way, we are talking about fixed income here. So when I am talking about cash enhancement product, it's included in the fixed income world.
It's in there,
so this is my question was more cash enhancement against bonds.
Your question is exactly the right question, and it's the question that we've been tackling, right? One of the reasons why Credit Suisse went under is because money markets was so attractive and people flooded into it. The honest answer is that we probably all quite like cash.
True.
By the way, where did you put your compensation? Myself, I did.
It was all in Credit Suisse shares and A-tier 1, so I paid a lot of tax on what I received. So it wasn't really the best.
The good thing is you pay less tax now, so you're always at the bright side of the things, isn't it?
Hence the grumpiness.
No, but what I mean is that. Is that for with 4%, 5% levels, being on the short-term part of the curve with no risk is probably the most, for now, is probably, this is our issue, by the way, which is transforming this on the long-term basis. But it's probably the safer path to ride, in all honesty.
Okay, I think time is up. I would like to thank you so much for this lively panel here, and I hope you got some insights in this, again, very interesting asset class. Thank you so much. Good afternoon.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory.